I went into psychotherapy for the first time in my life. And it was like a light switch. It was one day I was totally blind. The next day I could see. And for the first time in my life, I really started seeing all of these core strengths that I had looked at up until that point in time as being weaknesses suddenly became my primary strengths. And that's when finally I started getting my feet planted financially. And so I started investing in real estate, realizing that exchanging my time and expertise for money was probably not the smartest thing in the world.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
Today's guest and the conversation really takes us on a journey of understanding what that fulfillment is and to keep going through the challenges that we have in life, not only professionally, but as an investor, as a person as well too. Building up a portfolio pre-2008, just the challenges of leverage when things go wrong. And then how to overcome that. Go from a passive investor to now he's an active investor in commercial real estate, from multifamily, mobile home parks. Just a great conversation, learning about that journey and learning about the person. Today's guest is a Ph.D. holder in organizational systems psychology, empowers professionals to pursue their passions while securing financial freedom. An awesome piece. And that freedom, not only financial, really elevates us to that point where we find that true fulfillment, that true happiness. Why are we here? Why do we want time? Why do we want money? What are we going to do with these things? Everybody, please welcome Dr. Alan Lomax to the show. Alan, welcome to the show. First of all, where are you coming from today?
Well, Brett, thank you so much for having me. I am honored to be with you, and I am coming from beautiful Appalachia in western North Carolina.
Oh, very nice. So I'm not too far from you. I'm actually in Rock Hill, just outside of Charlotte. So.
Oh, okay. Yeah, we're neighbors practically.
We're close.
Yeah.
Oh, very nice. So here we are. We're going to talk about some real estate. But before we get there, Alan, can you let the listeners know just a little bit about your professional background before you got into real estate?
Well, that's a long story.
Yeah.
It took me a long time to grow up. Just to premise this, I think that most people, certainly most professionals I know of, and I think most people in general, have a burning desire to make a positive impact in this life before they leave this life. But all of us, in some way, shape, or form, we go through our college, university experiences with all these idealistic ideas of what we're going to do to make that major impact. And we get into the work world and we're bogged down by bureaucracies. We're bogged down by student loan debt in many instances. We're bogged down by all kinds of demands, and we get lost and we lose that dream. Those are mundane examples, but that's what happens really to most of us. And it certainly happened to me. And somehow I graduated from high school, very lackluster performance, went on to college, had a very lackluster performance, graduated, got married, went from dead-end job to dead-end job to dead-end job. And finally, my wife had enough of it, and she ended the marriage, and that was my rock bottom moment. I went into psychotherapy for the first time in my life, and it was like a light switch. It was one day I was totally blind. The next day I could see. And for the first time in my life, I really started seeing all of these core strengths that I had looked at up until that point in time as being weaknesses suddenly became my primary strengths, and that's empathic understanding and unconditional positive regard. And so I went back to school, got my master's in counseling, got a university counseling position, and completed my Ph.D. and found tremendous fulfillment as a professional in higher education. And that's when finally I started getting my feet planted financially. And so I started investing in real estate, realizing that exchanging my time and expertise for money was probably not the smartest thing in the world. And so I started investing in real estate and developed a phenomenal amount of wealth in a relatively short period of time, but did it really pretty accidentally. And then 2008 hit, and I lost my job, my identity with that job, and I lost a good portion of the wealth that I had built up at that point in time. And through those very, very dark days, I looked back and I could see that I was still that seventh grade boy, consumed with homophobic self-hatred. And even though I had a PhD, I still saw myself as intellectually inferior. So as looking at those, I came out of a closet bigger than a Kardashian's and embraced my fabulous gayness, and at the same time identified my reading, writing, and spelling challenges as the dyslexia that it has always been. And I looked at what I had accomplished with real estate and realized that I needed a whole lot more education. So I started getting educated, went into a mastermind group, hired coaches, and I changed the way that I do my real estate totally and completely, from a hands-on approach to a totally passive approach. And that is where I am today, and have exchanged, and I have stopped actually exchanging my time and expertise for money. I still work in higher education for the fulfillment, but I get my income from multiple streams of passive income. And what I do these days is I empower professionals from all walks of life to do the same thing, develop passive streams of income to stop exchanging their time and energy for money, to reignite their dream of making a positive impact in life.
So in, pre-2008, tell us a little bit about your first real estate deal. When it sounds like to me it was more active pre-2008.
I was essentially investing in single family homes. I was doing what I started out with what they today call house hacking. I didn't know the term at the time, but that's what I did. I was living on Guam. I was working at the University of Guam, and I bought a piece of property in Durango, Colorado, and I built essentially a duplex so that I would have a place to go back to when I was in the States and rent out the other part to pay for the mortgage on that. So that was essentially my first deal. And then I came back to the States. I ended up here in Appalachia, and I intentionally purchased a house way bigger than my needs met, and I broke it into a triplex and was renting out 2 other units. I then purchased another large home, broke it down into a triplex, and was renting that whole hold property out. I got into some small mobile home park endeavors and also was doing some fix and flips during that time. And all was going well. And it surprised me that how fast one could develop wealth, even through those processes. And of course, there's two major drivers in real estate, whether you're doing it actively or passively, and that is the hedge against inflation and the tax liability reductions make a tremendous difference in wealth development, and those things were working for me tremendously well as the income coming from the rental properties and from the fixes and flips. The problem in 2008, which was a problem for a lot of people and so many gurus you hear out there, is leverage your property to the max. And so that's what I was doing. And that's great and fine as long as the economy is in an upward cycle. But when that cycle goes the other way, if you're over leveraged, you're in deep trouble. And that's what happened to me.
And what do you mean when you say leverage to the max?
Well, I was leveraging these properties like 95% loan to value on these properties, and that was fine until suddenly the downturn hits and people can't pay their rent. I can't pay my mortgages, and everything just turned upside down overnight. In
those projections, when you're doing 95% LTV, so you're borrowing basically 95% of the appraised value of the property, you're leaving 5% in the deal. What did the cash flow look like when everybody was paying their rent?
It was probably about $50 per unit was the cash flow on those.
Okay, and there's no reserves or anything included in that. That 50 is just like after. Were you paying property management at the time?
I was doing the property management at the time.
So you're super, super tight. No room for any errors or any changes. Wow. Okay. What's a way that you would say, looking back in those situations? I know now you're in the multifamily passive. We're going to get into that. What was a way or something that you learned about the leverage positions that you do differently now if you were doing single family or the duplex, the quad, tri type scenario?
Well, I might still purchase those properties at that 95 to 5% leverage rate there, but I wouldn't refinance at those rates. I would allow the appreciation through the improvements of the property and just the natural appreciation of that to reduce that loan to value considerably. That's what I would do in those situations. And had I done that, but I was refinancing and taking money out of those deals to the max, and I wouldn't do that again.
Yeah. Is there a takeaway from that scenario for you based off of how you learned or where you were learning to do this? How did you vet these people? Or is there anything to learn from the gurus that you mentioned about, maxing out, refinancing? Is there a way that the listeners could maybe avoid a situation like that? Or was it directly related to, the cash grab game, basically, when things are good? Because when the market's good, it's hard to judge or tell who's good, right? Because it's fruitful, right? And then that downswing is really where the market starts to thin out operators, thin out different wholesalers, fix and flippers. But was there a way that you could think of, or maybe looking back at some of the people that you did learn from, that you wouldn't do again?
Well, I actually wrote a blog post on this. There's a lot of gurus out there in the real estate industry, and of course they all claim to be knowledgeable and have all of the perfect answers. Well, I was just really quite naive, and I didn't really do any research beyond just one or two different gurus out there. And I was basically flying by the seat of my pants. And so looking back on that, how would I avoid that? Well, I would really get a true education in terms of real estate investing, and not just take the word of someone who has a published book, and in fact, these gurus that I was following, that there was actually just one in particular, had several published books and had been publishing really for a couple of decades. But he had one plan, and it was that one plan is to essentially keep leveraging properties over and over and over again. And if I had broadened my education at the time, I could have protected myself and preserved my assets through that downturn, like some of the more knowledgeable and experienced operators actually were able to do.
Yeah. So this next step, then, bringing back the sunshine, would be. Was that instantly into commercial, or did that involve single families on the way to commercial, or did you go directly into what I'm hearing is syndication style passive investing in multifamily properties?
Yeah, it didn't. In 2008, I didn't jump immediately into multifamily. I'm a slow learner. So I continued doing fix and flips, and I got into some spec home development. And finally, around 2016, I began to realize that these are not passive investments, first of all. And I went back to work in higher education, and so they were taking a lot of my time and energy away from really where my passion lied. And the big problem with it is the scalability. The scalability is just not there in the single family space unless you want to make it a full-time job, which I did not want to do. And so I started looking around and actually started doing some actual study and research, and really starting to connect with a lot of people. Just broadened my network considerably. I actually have a podcast, and so through that podcast, I developed a huge network of operators, learned from them through each and every podcast I did, and started following those who I knew had very successful track records, and eventually joined a mastermind and a coaching program. And going into that, even going into commercial real estate, it was my intention that I would actually be an operator. And it wasn't really until actually looking into a couple of deals early on in that process and starting to develop networks with brokers and what have you, and putting in a number of LOIs, that it really dawned on me that I'm putting a lot of effort and energy into something I don't need to be doing, that if I just move to the passive side of this, I can develop my wealth much more passively, with less risk, and with a whole lot less effort. So that's kind of my journey there.
And the difference in the passive versus active in this syndication in the multifamily space, do you feel that you need more capital to start with if you were coming from the passive direction than you were in the active? Because in the active, I can do some things based off of the way that the deal is acquired to basically generate some of that. But for that passive side, you really need to have that cash in hand, right?
Well, not as much as what most people think. And certainly the professionals I work with, any professional who's been in their profession for anywhere from 5 or more years, probably have the $50,000 to begin with, which is generally the minimal investment on the passive side of it. There are occasionally opportunities for $25,000 or so, but generally speaking, what you need to look at is 50,000. And most professionals have that. Either they have it in retirement accounts. They may have it in the equity in their home. They probably have various life insurance policies that have a cash value to them. And they probably have a CD or so here or there. So it's very likely that most professionals who've had any success in their careers probably have the minimal amount to get started in passive investing.
And in passive investing now, Alan, what types of properties or classes or areas are you looking at? Like what brings the sunshine back to a deal now? Just give us a high level overview of your favorite kind of deals.
Well, I have been primarily investing in multifamily properties, and they have been doing quite well. The market has stagnated really the last year and a half. The deals that bring the kind of returns that I'm looking at are very, very difficult to find. They are out there, and good and experienced operators are bringing those forward, but it's challenging. The other things are mobile home parks, and I'm beginning to like those more and more. They have, generally speaking, have higher rates of return. They are multifamily in itself is generally pretty recession resistant, but mobile home parks are even more so than just your general multifamily. So I'm liking that more and more. And then there are some really good opportunities that are emerging in mixed industrial, small industrial, mixed use kinds of opportunities. There seems to be a lot of opportunity there. And if you work it right, there are opportunities in retail and office. As everyone is running away from that, there are some opportunities that are starting to come to bear in those particular segments.
Yeah, I hear this a lot too. The trailer park, the mobile home properties where it's resistant to a fall in the market or fall in the economy. Tell me a little bit about what that means to you.
Well, there's a couple of reasons that it's kind of insulated from that. One is that the mobile home parks that we would invest in, we don't own the homes themselves. We own only the lots, and so we rent the lots, and the renters own their mobile homes. Well, they're not likely to up and pick up and move their mobile home. They could sell it, but that is another challenge on top of that. And so it's a pretty stable rental market. And the other thing is it is serving an underserved market. It is the lower end of the working class individuals, and they don't have anywhere to move downward. They're already down essentially as far as they're going to be able to go. So it's providing a huge need where there's a huge demand for it, and so all of those things coming together makes it quite recession resistant. And there was one other thing and it slipped my mind, but there's actually three different factors that make it a recession resistant investment there.
Yeah, it's just fascinating as you do, I guess, step up. And for me, I didn't grow up with money, so I've been able to step from pretty low. But when I look back now, it's amazing how quick, not that my heart gets hardened, but how quick I am to forget what that's like. So just the other day, we all went out and to the store for the weekend or something, right? Just some simple stuff. Some things for the yard, some landscaping stuff, maybe out to lunch, and maybe a few grocery items. But we looked at what we bought, and then we turned it around and looked at for the minimum wage here in the state of South Carolina, what a typical person would have to work after taxes in order to pay for that is absolutely mind-blowing. And when you talked about the recession-resistant thing, I just brought to my mind is like when you think it's bad, that's a perspective, and you always need to check yourself when you think it's bad, because guess what? It can get worse. You said that they're pretty much at the bottom when you're in that scenario, but there's always the street. There's always not being able to afford anything. So there's always room for things to get worse. So we should be grateful for what we have in those times, and not get hardened about where we're at and where we've came from. I think that's really, really important. If the listeners want to get in touch with you, Alan, I've actually looked at your website here, and it's more on like what you've been talking about, the passive investing side. And I've heard you mention a couple different asset classes here, right? With the storage, the industrial, the multifamily. I'm hearing a lot of this too, as I'm speaking with other people. They can find you at steedtalker.com, right? That's STEEDTALKER.com.
That is correct. Absolutely.
Awesome. And what's next for Alan?
What is next for Alan? Well, we are in the process of putting together a foundation, and the foundation is in conjunction with the name of the company, Steed Tucker. We're developing a foundation to develop a place for autonomous horsemanship to grow, which is aimed at re-educating the equine industry to help them realize that they don't have to have a slave-master relationship with their horses, that they can have a mutual and caring relationship with their horses. So that's what's next.
Very cool. Well, thank you for your time today, Alan. I appreciate it.
Well, thank you, Brett, for having me. It has been my pleasure.
Well, absolutely. And just keep going. I'd say it's a perfect example of keep going. Because when that sunshine seems to be hiding, there's only a cloud in front of it. It's there for us, but being grateful for where we're at, and grateful from where we've come, and all these things that we can learn, because it's through pain where we grow. And it's just those remarkable opportunities that don't feel remarkable in the time, but we grow so much from them. Thank you again for your time. And the listeners out there today, as always, not just your time, thank you for your attention today. If you have any questions for us, I'm still waiting for you to email me at info@physicianwealthsystems.com if you want to be a guest on the show here, or if you know somebody that would be a great guest. We would love to reach out to them, have that conversation with them. Until next time, this is the Real Estate Mogul MD.